Welcome to the Stock Market Palantir. Today we are going to talk about IRWD, Ironwood Pharmaceuticals. That's ticker IRWD. Just executed one of the most, well, frankly, one of the most explosive moves we've seen in specialty pharma this quarter. It surged over 110% in November of 2025. And this move, which happened right after a huge earnings beat, it really raises a critical question. Was this rapid repricing, a rational, justified correction based on real, tangible fundamentals? I'm talking clear operational success and getting rid of some major regulatory uncertainty. I'm going to argue that, yes, the market was simply fixing an absurdly bearish price.
And I'll be arguing that the whole thing fundamentally a structural event. See, I believe the sheer magnitude and the speed of that move were overwhelmingly driven by something else entirely. We're talking aggressive activist investors, a forced short-covering dynamic, and the very opaque world of market microstructures, specifically dark pool activity. This wasn't just a stock catching up to its value. This was a structural arbitrage event.
And I'll be arguing that the move was completely justified by a corporate turnaround that management has, finally delivered, coupled with some really critical de-risking events that give us a clear line of sight into their cash flows.
And I'm going to argue that those structural forces, specifically the high-stakes playbook of Sarisa Capital and the mechanics of dark pools, were the dominant accelerators. They turned a strong quarter into an explosive, non-linear rally that goes way beyond basic valuation.
Okay, so let's start with the operational reality of Ironwood. Because look, without the fundamentals, none of the structural stuff really matters. For a good chunk of 2025, IRWD was priced for what I can only describe as terminal decline. I mean, the stock was trading as low as 53 cents. That implies the market believed its main drug, Linzess, was just, dissolving. So the November rally was just the rational and frankly necessary unwinding of this incredibly bearish thesis. The Q3 2025 earnings report was the clear turning point. And the numbers, they didn't just meet expectations, they fundamentally blew the short case out of the water. Adjusted EPS came in at 24 cents. That beat the consensus of 11 cents by an astonishing 118%. Revenue was $122.1 million, which just crushed the $68 million everyone was expecting. And this wasn't random. This was all about execution. The U.S. Linzess franchise drove a 40% year-over-year sales increase. But here's the most critical part. They finally stabilized the gross to net pressures. For our listeners who, maybe don't live and breathe biotech P&Ls, these are the huge rebates paid out to middlemen that can basically eat up all your sales growth. By getting those under control, the real underlying 12% patient demand growth was finally able to hit the bottom line. That alone completely changed the company's trajectory.
Okay, I hear you. And I'll grant you, the Q3 beat was spectacular. No question. The execution on Linzess has been strong, and stabilizing gross to net is, yes, a very positive sign. However, I just don't buy that fundamentals alone justify a 110% surge in a single month. A good quarter, maybe it moves the stock 15, 20%. A move this big suggests the market is pricing in something else, an imminent structural change. This was less about your standard discounted cash flow model and much more about structural arbitrage and liquidity mechanics driven by the big players. And the market microstructure, it tells a very different story about what was really powering this rally. Let's just look at the off-exchange activity. During the peak of the rally, dark pool trading accounted for between 49 and 53% of all reported short volume. Now, when you see volume that high, you have to look past the label short selling. This is what's known as the market maker short dynamic. High dark pool short volume, especially when a stock price is rocketing up, is actually the ultimate bullish signal. It's counterintuitive, I know. But why? Well, it means there is massive institutional buying demand. We're talking huge block orders being routed off the main exchanges. So the market makers, they're forced to short shares immediately just to fill those buy orders and provide liquidity. They're essentially scrambling to keep up. And this created a really intense micro squeeze that fueled that, 31.8% jump on November 10th alone? And furthermore, the real driver here isn't just the Q3 cash flow. It's the activist. Sarisa Capital, led by the very successful Alex Denner, has nearly 10% of the company. The market is pricing in an end game, the high probability of a sale to a logical buyer like AbbVie, who already co-markets LINZESS. It's not about valuing cash flows to 2029. It's about a buyout. The fundamentals were the match, sure, but the structural forces were the gasoline.
I see why you emphasize the mechanics, but those mechanics only explain the speed of the move. They don't define the underlying value that the institutions were so aggressively trying to buy. And that value is now, for the first time, highly visible. Management didn't just report one great quarter, they gave the market solid, high-visibility guidance. The revised full-year 25 guidance, it lifted revenue to $290 to $310 million and adjusted EBITDA to over $135 million. I mean, that signals a clean, high-margin path right into 2026. This isn't a speculative biotech anymore. It's a stable cash flow machine, an annuity, right up until the patent cliff in 2029. And we have to talk about the elimination of the tail risk. The biggest deal this quarter was the regulatory clarity from the Inflation Reduction Act, the IRA. The negotiated Medicare price for LINZESS starting in 2027 was set at $136 for a 30-day supply, and that was, quote, in line with expectations. This removed the catastrophic uncertainty, the fear that the government would just gut the price and the company's value along with it.
Right. So once that risk is off the table, analysts can actually model the cash flows to 2029 with precision. That de-risking event instantly boosts the present value. It has to. Plus, you have the pediatric approval, which, okay, it's small, but it validates their R&D team. It shows they can manage the life cycle. All of that creates fundamental value that just had to be repriced, regardless of what Sarissa is planning. I'm just not convinced that big money is valuing this as a secure annuity to 2029. If they were, the buying would be slow and steady, not this rapid-fire squeeze in 1 month. The lens institutions are using is the activist blueprint. It's the Alex Denner playbook. They see the great Q3 numbers, they see the cost-cutting, and they don't see a long-term operating plan. They see management dressing the bride for a quick sale. Denner's history is the template here. I mean, look at his wins. Ariad, Biovorativ, the medicines company. In every single case, a good fundamental catalyst was immediately followed by pressure for a sale, realizing huge premiums. The market knows this playbook. So the value isn't based on holding until 2029. It's based on the premium you get in a near-term buyout, maybe $35, $40 a share. And you can see this focus on a corporate endgame in the insider activity. You have massive institutional buying from firms like Renaissance and Bank of America happening at the same time as certain Ironwood officers are, selling stock. Now, sure, insider selling after a rally isn't unusual, but this pattern is classic for a company that's in play. Executives cash out while the institutions pile in to capture the takeover premium.
That's a fair point on the divergence, and I'll concede the pattern fits. But you're still prioritizing the means, the sale, over the foundation, which is the asset itself. Sarissa can't demand a high premium unless the asset is de-risked and kicking off predictable cash flow. The operational success we saw this quarter is the reason they can dress the bride, not just a consequence of it. Let's go back to the microstructure argument, because I think you're overstating the power of the dark pool mechanics. You're claiming the high off-exchange volume is the primary driver.
I am, that's right, because that volume, upwards of 50%, it isn't neutral. It's an active mechanism that creates asymmetry. It shields those huge institutional block buys from the transparent exchanges, from NASDAQ. If those funds had tried to buy millions of shares on the open market, the price would have gone parabolic immediately, killing their entry price. The opacity of the dark pool is what fundamentally shapes the price discovery here. It lets the big funds accumulate quietly, which guarantees that relentless, steady upward pressure, that micro squeeze, without causing a panic. So the price action is primarily a structural correction of a liquidity imbalance created by these guys, not just a simple correction of earnings. The structure is what made the speed possible.
Okay, I see your point, and I agree the structure dictates the velocity of the move. I'll give you that. But you're confusing the how with the why. Massive, sustained institutional demand requires an underlying justification. I mean, funds like Renaissance, they don't just go out and buy 80% more shares based on the hope of a sale. They're responding to tangible evidence that the asset's entire risk profile has changed. That huge volume spike over 10 times the daily average on November 10th, that confirms their conviction. and the conviction came from the operational wins and, crucially, the regulatory certainty from the IRA. That's what removed the uncertainty discount. The market structure just let it all happen faster. The price rise was inevitable. The mechanics just compress it into 1 month instead of 3.
While we also have to consider the information asymmetry, especially with retail investors. They're clearly trying to coattail Syriza, which is fine, but there's a lot of confusion out there, and that creates opportunities. I'm talking about the persistent myth of a reverse stock split you see on platforms like Reddit and StockTwits. It all comes from the 2019 Cyclerion spinoff. Back then, shareholders got 1 Cyclerion share for every 10 IRWD shares. So when casual investors look at a historical chart, the data is adjusted and they mistake that 1-for-10 ratio for a reverse split, which, usually implies a company's in trouble. This distortion means anyone who actually understands the history can take advantage of the confusion.
That's an interesting point about the confusion, though. I'd frame the Cyclerion event differently. The fact that the experienced retail users, the OGs, have to constantly correct this reverse split myth, that actually highlights that there is a group of sophisticated people who see the deep value because of that history. That spinoff wasn't just some administrative quirk. It was the fundamental, activist-driven decision to separate the profitable Linzess cash cow from the risky, cash-burning R&D pipeline. That strategic move is what led directly to the lean, profitable company we see today. The spinoff was the foundation for this recent success. So the deep value investors understood that this past move made the recent earnings beat possible, and that's what drove their conviction.
But the confusion itself still provides cover. The fact that they have to correct the narrative proves the misinformation is out there, letting institutions buy up shares more cheaply without ringing all the alarm bells. The core structural mechanism is still the expectation of a buyout.
I think we can agree the underlying value was the magnet and the activist was the catalyst. But the stability required for any premium, that high visibility into future earnings, that was provided by Q3 and the IRA clarity.
And I'll maintain that the accumulation pattern and the market microstructure show that the primary factor wasn't the annuity value, but the accelerated timeline towards a sale, engineered by Syriza.
So to summarize my position, the price appreciation was a necessary, justified correction, driven by tangible operational victories, a spectacular earnings beat, stabilizing pricing, and crucial regulatory clarity. These factors provided a secure cash flow annuity through 2029, making the previous valuation completely unsustainable.
And my perspective remains that while the fundamentals provided the trigger, the explosive magnitude and structure of the rally, seen through institutional dark pool accumulation and the clear activist playbook, suggests the dominant factor is the pricing in of a corporate sale, not just the profitability of the Linzess annuity.
The IRWD narrative really forces investors to weigh near-term commercial execution against these long-term structural gambits.
It highlights that a complete understanding requires integrating financial data, market mechanics, and activist strategy.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.